Hey guys, I'm Marcin Droz. Today I'm joined by Ross McCallister. Ross McCallister is the co-founder of MC Companies along with his partner Ken McElroy. We're sitting in one of their recent acquisitions, Briarcrest Apartments, here in
Which is
Carlton, Texas. Yeah.
Dallas Metro.
Dallas Metro. First of all, Ross, thank you for making the time. I
So,
appreciate having you here. And
my pleasure, Marcin.
so, just for context, guys, I've been following Ross and Ken for given 20 years now.
Yeah.
And the first deal I ever got to work with you guys on, you guys still own today, Sun City Apartments, I think.
That's true.
Or the fountains at Sun City. That's what it's called, right?
Right.
So it's been amazing. Back then, you guys were a couple hundred million AUM, and today you guys are 2 billion in assets plus and growing. So today, Ross, I want to talk to you about obviously MC Companies, the culture you guys have here, what you guys have managed to do in terms of the business, talk about the differences between development and acquisitions and when one makes sense versus the other. You're just telling me that you guys have renovated over 2,000 doors in the last
2 years.
2 years here alone. So there's tons of stuff we can get into there. Plus, you got a bunch of stuff shovel ready. We can talk about the market. I'd love to know what you think building versus buying and in that regard. And everybody wants to know what your crystal ball says over the next.
It's going to be a short conversation.
Over the next 12 to 24 months. So Ross, you and Ken, you guys have been together in business for, was it going on 30 years now?
Actually, it's 23 years.
23 years. Okay.
2001 is when we merged our companies together.
And when you and Ken decided to start working together, he had the property management business, you had the construction business, and you had last names that started MCMC. So obviously
Yeah.
he could bring it all together and make it work. So that first project you guys did together, was that a development? Was it an acquisition?
I think the first project we did together was we did the acquisition of Fountains at Sun City. The
Really?
first time. We've actually acquired it 3 times.
Is that right?
It was owned by a client of Ken's, and he wanted to. It was his only Arizona asset. It's a very New York real estate developer. He had this one Arizona asset, so he gave us the opportunity to buy from him, and so we were able to put a raise together through some investor contacts we had and bought the property. The second one we did was Edgewood Apartments, which was a client I had in Tucson. That was a third-party management account, and he wanted to sell it. Gave us the opportunity to buy it. Plus, we were able to buy an additional land next door. So we bought 140 units from him, and then built another 112. So we had 252 units, and we still own it to this day.
That's amazing. And the fact that you're able to buy stuff and hold it for 20 some odd years, right?
Yeah,
That's,
refinanced it 3 times.
and we'll get into that after because the refinancing is really where you make your money, right? And we'll definitely talk a little bit about that. But just for some context, Ross, so obviously construction is your background. We talk about trades, being a superintendent on site. Give us a little bit of like context for how you got to running the business that you're here today with the backstory a little bit.
As I was telling you earlier, when I got out of school, I got into Savings and Loan Association, which is, for those of you who are under 40 or 60, a Savings and Loan Association was a bank that basically specialized in real estate lending.
Yeah.
And so I was 8 years in community banking with the Savings and Loan Association. That was my first job out of college at 23.
And Ross, a little modest about it, but I think he was the youngest president of an SNL at the time.
That's correct.
So that was quite an experience. And then obviously you transitioned out of that. And I remember you telling me you went to work for a real estate company on the development side, on the acquisition side.
That's correct. Yeah. Came to Tucson, got an opportunity to move to Tucson and go to work for a real estate developer / syndicator, and was there for 2 years before I branched out and started my own firm.
Did you ever think when you started your own firm that it would grow into the thing that it's become today?
I never thought I'd be self-employed, frankly.
Is that right?
I come from a family of entrepreneurs.
Okay.
The last thing I wanted to be was an entrepreneur. The uncertainty and the risk and you know all the stuff that goes with being self-reliant, but after 10 plus years of working for other people, it became clear to me that I would be happier at being in charge of my own destiny. So in 1985, my wife and I started the McCallister Company, another brilliant marketing ploy.
You could have been a stand-up in another. You started your own business, and then did you immediately go to applying the background you had in finance and trades and all that stuff into development or acquisitions, or what were you?
Yeah, so it's kind of an interesting time. This is mid 80s.
Okay.
Very, very go times development was basically completely based on tax benefits with
Okay.
little or no regard to the economics of the projects. And there was, because investors were very interested in getting those tax benefits, they were in essence throwing money at people. So so getting equity was not bad. And then because of my financial background, I had like instant credibility with financial institutions.
Right,
They
because they saw
actually
your
thought
resume.
they know what I was doing. Little did they know. So that's in essence what it was, sort of the kind of a perfect storm of opportunity for me, because I had the background to be able to go the financing side. I had been involved in real estate construction since through my banking career and with my previous employer. So I knew enough to be able to put together a vertically integrated company where we did our own building, we did our own property management, and we did our own development.
And then obviously the projects that you were doing on your own, were they mostly in the Tucson area at the
They were
time, or?
completely in Tucson. Yeah.
Excellent. Any of those projects you drive by today and you're like, I did that.
Yeah,
Just a
all the
whole,
time.
yeah. All the, of course, yeah.
I go out of my way to go by a couple of them. I go out of my way to not go by a couple of them.
Oh, is that right?
But
Do you still own interest in any of the original properties
no, I
still?
don't, not anymore.
Is that right?
Yeah.
Do you ever look back at some of the original projects you did and you're like, oh, I should have done that. I should have done that. I built that. That's too big. That's too small.
I really don't. I'm amazed at, just to give you an example, the first apartment project that we built was 96 units on 3 acres. That's about 33 units to the acre.
Okay.
And today, the projects we build are 16 to 20 units per the acre. The project in 1985, 86, 87, a 1-bedroom unit was, I got a better comparison. A 2-bedroom unit was 750 square feet. Today, a 1-bedroom unit that we build is 700 square feet.
Okay.
So I sort of compare it to, but this was all market driven. I mean, this is what people needed, and this is what they kind of expected out of apartments in those days. It was considered to be transient housing. It was considered to be, a stop off.
Before.
A way to buy a home.
Yeah.
And so that's, we now have that shifted now to more of a renter by choice. So we have to provide a different product.
Yeah. Yeah. And I was going to ask you about that because I know I've heard you and Ken talk about it a ton, where it used to be, like you said, a different dynamic where you were renting. Now it's, whether you're choosing or that is where you're going to be. That's kind of the dynamic, right? So you create all the amenities now, and even the washer dryer concept, that wasn't normal, 20 years ago,
Correct.
30 years ago, right?
Yeah.
So
I think I built the first, well, it wasn't the first, but it was one of the early projects that had washers and dryers in it.
interesting.
Tucson.
So let's talk a little bit about the company today, because you guys Ken was telling me you guys are about 300 employees right now.
Right at it, yeah.
Yeah. So culturally, I mean, when I met you guys almost 20 years ago, you guys weren't 300. You had a bunch of employees, but it was a different company than it is today. So how have you guys kind of developed that culture and created that environment so that people, they want to be part of that? Because, managing 300 people, I mean, my God, how do you do it?
Well, you have really good managers.
But even the managers have to have a guiding star.
We are very blessed with.
Yeah.
I think it starts with, the establishment. First of all, Ken and I have always believed in this business and in the opportunities that it provides.
Yeah.
It can provide to our investors, to our employees, and to our residents. We have understood the obligation and responsibility of providing high quality rental housing for our customers. And that requires as we were talking about earlier, innately, if you're going to do that, then you really have to care about people, and you have to care about what it is that you're giving them. And you have to have a sense of pride in it, right? So I don't want to sound all altruistic about this. This is something we also feel like this is the best way to get the highest returns on the building. So because we have sort of fostered, this philosophy of caring about people, that attracts a certain person to us that cares about people. It's amazing some of the stories I can tell you about the extent of things people have done for our residents. The first one that comes to mind is there was a hurricane in Houston, and one of our properties was badly damaged and was stuck without power. First thing that happened is I got a text the day after the hurricane and from the property director, who said that Martine, our maintenance supervisor, swam on site to go check on the residents.
Swam on site. Okay.
So that was the first thing. The second thing that happened is our team in Austin got a U-Haul and filled it up with, went to Costco, filled it up with water and blankets and, snacks and food and whatever they could get. And they drove it to Houston and they handed it out to the residents. They did all this without any of us asking them.
Right.
That's just two examples. I mean, there's a whole bunch of them, from holding the door open to picking up somebody's mail to doing all the taking care of the dog or whatever else needs to happen that people do all day long. But that's because of that, we get people that want to do that.
Yeah.
And we have a set of core values that we put on our website. And when we do job interviews, we ask people specifically how they relate to our core values.
Good.
And those core values were not imparted on the company by Ken and myself. Our executive team looked at certain people in the company and said, these are attributes, these are values that they represent that we'd like for everybody to represent. And that's how they were developed.
Yeah, that's such a good way to do it, because if you force it out of people, where if you try to force your way of looking onto the world onto everyone else, it's not the same. Whereas if you take the best of the people that you already have around you, that makes so much sense. And then the thing that's always kind of rung true to me with you guys, with you look at the MC brand, even your website, the portal, like everything is meant to be easy for the client. And that's such an important thing, because so many people, especially in the real estate business or even the investment side, you almost forget that there's a human being involved. And more importantly, that the amount of money that they're spending with you is probably more than anything else they're spending elsewhere.
True.
So their biggest payable on a monthly basis from their check is where they live. And what you said to me earlier is about when, like, ultimately when good things happen at home, good things can happen elsewhere. So if you provide that environment for them where, like you said, the kid can study for his math test, or the single mom doesn't have to worry about a leaky roof, or the guy that's working triple shifts doesn't have to worry about the air conditioner not working. And if you provide that environment for them, they can be good, productive citizens in society. And that was really cool. I'd never heard anybody say it that way.
I think that's really true.
Yeah.
I mean, if you think about it, that it can just, when something's wrong in your own home, what kind of an irritation that is.
Yeah.
Much less if it's a serious problem.
It's true. And then, so obviously we walked the property here today, and this is as great of a 80s vintage property as I've probably ever seen, because 80s is, we're in the 20s, so that's 40 years ago, right? So this property still looks like it was, inhabited. Yes. I mean, fresh paint, fresh, everything is in fantastic shape. So when you look at your portfolio, I know you guys have 80s vintage, probably have some 90s, 2000s, and new builds. And obviously we're going to talk about the development stuff. But when you look at your portfolio today and you look at, where you guys are at, is there a case for when you buy versus when you build? Or how did you guys get to where you got to today, where the percentage of new stuff versus renovated?
This is a cyclical business, as everybody knows. If you don't like what's going on in real estate, wait 90 days, it'll change. But you have to be somewhat opportunistic. Okay. So what we look for, and I'll give you an example, and I think you asked me earlier about 2008. So some of our best growth occurred right after 2008 and into 2012-13.
Okay.
And that's because we were headquartered in Arizona, and Arizona was ground zero for the housing crisis. So I think unemployment was running in the 15% range, and housing delinquencies was in the 15 to 20% range. So there was not a whole lot of opportunity that we saw in Arizona, and we had not been able to develop anything, or not. I think we developed one or two projects, but because of the competition from new home builders, we couldn't compete for land, and we couldn't compete for customers. And easy credit, which is wonderful.
And for those of you who are wondering, what do you mean customers? And I think what Ross means is, because back then it was so easy to get a mortgage.
Yeah.
You had people that had no business buying, and they were leaving the apartments.
Right. More than once, we turned down somebody for an apartment who had a pre-approval letter from a mortgage.
No way.
More than once.
I remember those days.
So we said to ourselves, okay, so 2008 has come. We can't really do much. So where can we go where there is jobs, people have income, where the housing crisis hasn't been, great, at least in real estate, it hasn't been not a big hit like like, Nevada and Florida and Arizona was. So we looked at Texas and we looked at Oklahoma, and we found where unemployment was low and people had income and there was really no real new development. So that's how we got out here, and that's how we started looking at that. So and by opportunistic, I mean we went where there was a market and where we identified what, how we could fill a need. And one of our, we were looking for properties where we could just put washers and dryers in. We weren't doing anything else. We might do some, painting or exterior painting or something.
Yeah.
No extensive renovations at all. So it was all about our value add was washers and dryers.
Yeah.
So that grew, of course, into today, where now it's washers and dryers and new stainless steel appliances and wood vinyl floors and new fixtures and, just basically a brand new unit. So, and that was an opportunity as well. And that because you could see how if you did that, then the customer or the resident would pay you a premium because he got a nicer place to live. So here at Briarcrest, for instance, that premium was like $300. Still is today, as a matter of fact.
Is that right? Okay.
As to development, we look at what you still look for the kinds of opportunities that places that where we can get opportunity. And we don't do development outside of Arizona.
Oh, okay.
Because we don't have the contacts in
That's actually very
Texas.
Refreshing to hear you say that.
We don't have the, we have a 40-year history of building with subcontractors and banks and real estate people who sell us land. And, that whole team is, we've nurtured that and we've nurtured all those relationships. We don't have that in Texas. So many people make a lot of money in development in Texas, and more power to them, but we're not in this to develop for development's sake. We're in this to develop and build to provide a product that's got lasting value for our investors. And that's really just a matter of, again, being opportunistic. For right now, for instance, Dallas, there's 45,000 units under construction.
Is that right? Wow.
In Phoenix, there's 50,000 units planned and under construction. In Tucson, there's 1,000 units under construction.
Is that all? Okay.
Yeah. In a town of 1 million people.
Is that right? Okay.
We believe in Tucson, there's opportunities to build.
And is there a reason why there's only 1,000 units going up in a market of that size?
Well, if you look at, we're going to kind of get in the weeds a little bit, but let's do
it.
Development is in metropolitan areas, especially ones with low barriers to entry, like Phoenix and Dallas and Houston,
right,
and Austin. You have this group. You get what's called a merchant builder, which is a guy who builds and then leases it up and then sells it. And so merchant builders don't like what's considered to be secondary market. So, and Tucson is considered a secondary market.
Right, because it's going to be a lot more difficult for them to assemble a team.
They can't get it sold.
Right.
Find somebody that's going to buy it.
Got it. Okay.
There's 100 buyers for a product in Phoenix. There's 2 or 4 or 5 or 10 maybe in Tucson. So, and they don't get the markup. Now, merchant buildings are great businesses, but as long as you can hit that cycle. So where we are now is that we're seeing developers coming on the market with product that they started in 2021.
Right. When everything was up and
when everything was up and interest rates were 3%. Now they're coming on the market and they're not able to get the price that they, in many cases, can't either break even or even lose money.
Right. What about those guys? I mean, this is a little bit of a sidebar, but the guys that were shovel in the ground 2021 at 3% and now are sitting at 7, 8, 9, 10% loans. I mean, isn't that kind of part of the strategy too for you guys on the?
Well, I was going to say that. So we're looking at those deals because why not acquire in Phoenix and Dallas and at significantly below replacement cost.
Right.
Then you get back to our development strategy, which is, like I said, limited to Arizona. And really today it's limited to Tucson because there is no excess supply. And I just read a study earlier this week that in the last 4 years, wages in Tucson have grown 27% and the cost of owning a home has grown 127%.
Is that right? Wow.
So, people are priced out of home buying in essence. So we believe there's, long term, and that's the way we don't build to hit a cycle. We build to provide a product for 8 to 10 years.
Yeah, you're not speculating. You're effectively saying, look, here's where things are going to be, regardless of the external or who's in office or where this is or where that is. Here's where we're going. Here's the long-term trend.
Right. And where's the long-term fundamentals? Exactly.
Yeah, that makes.
So we can build today in Tucson for an approximately a 6.75 cap rate.
Okay.
Whereas if you were on an acquisition, it's going to be in the 4 to 5, maybe 5.5.
Right. So you literally have that 20%, 25% spread
Right.
just by putting a shovel in the ground. And maybe that answers my question in terms of when you decide to build or buy, because
That's it, really.
you find the spread, right?
That's it.
It's an interesting way to look at it. And, it's interesting to hear you say that you guys you do the Arizona thing because your trades, your finance, everything is lined up. Like you got your dependable people, the people, when you go to a new market. So here in Texas, you guys aren't building, you guys are buying.
Right.
Right. Okay. And then Nevada, when you guys bought that other thing, you're buying, you weren't building. And that's a
Right.
different, once that certificate of occupancy hits, it's a different conversation than trying to get it across the line. Right.
Yeah. And we're looking primarily at 2021 to 2024 buildings that were built and are currently owned by merchant builders, that where we can acquire for less than replacement.
Yeah. Isn't it funny that the replacement cost conversation is such a big deal nowadays?
Yeah.
Because I remember when I first got into the business, it was like an insurance thing. It was like, oh, replacement costs. Like, why do we care? Oh, it was the insurance company. Like, they need to know. But now it's a big conversation, even for all the value add and, all the different things that.
Well, it's a big opportunity. But you can't ignore the rest of the fundamentals.
No.
Clearly. I mean, is it in a good area? Is
Yeah.
it got, is it functionally nice? Is it, is there employment close by? Is, all the other fundamentals gotta replacement cost is just a small little fraction.
Yeah. What always impressed me with you guys at MC is that you guys are vertically integrated, and there's so few people that do that right on the construction management side, the acquisition side, the property management side. For somebody who hasn't been in the business, you learn all three of those lessons the hard way because everybody is cost and fee struck. Everybody's feeing you to death all the way through the cycle. But if you're internalizing that entire thing and you make that your unfair advantage, which is what you guys have done. Ultimately, if you look at any of the large REITs or any of the institutional investors, they all do the same thing. They all buy or own or start a property management company.
Yeah.
Right. And then they internalize the building. So it's the way you guys structured it. 20 years ago, I didn't appreciate it, but having, ventured on my own in between and learned maybe things the hard way a few times.
Believe us, neither one of us learns anything easy way.
That makes sense. So Ross, I got to ask you, so we're sitting here, it's 2024, years kind of winding down, and, the Fed's talking about, teasing us with rate reductions, and, God knows what's going to happen with politics, but like, where do you see the housing equation going? And I mean that in respect to affordable housing. How do you solve, like, you mentioned to me earlier, you had some answers, so I'd love to know where you think, where you think the whole housing, opportunity issue crisis, like, what are your thoughts on that?
Well, there's no question there's a tremendous housing shortage.
Yeah.
I just read an article recently that we're 3.5 million apartments short of.
Is it that much?
In the United States of
needed
apartments, and that we need to build 1.5 million houses a year to make up for the current single family housing shortage.
1.5 million.
So you have that, our business is about job growth and population. So we look for markets where we can first and foremost get those two things. So we have a labor shortage as well. So there's a lot of jobs out there, and we have, in many places full employment. I personally think that, yes, the Fed needs to cut rates. Yes, because we're headed to a recession if they don't. I personally believe the Fed needs to drastically cut rates, but Jerome Powell hasn't called me and asked my opinion. But I don't think, I think inflation is here to stay in this 4% range. I think that a rate cut is going to be nice, and it's going to be healthy for the economy, and it's going to help. But, we're looking at a 5% mortgage rate, and at the lowest, maybe even closer to 6%.
Yeah.
But the interesting thing that I always come back to is I've been at this, I've been in the workforce in the financial industry for close to half a century. And what I think what we're going into is what I would call basically normal. That the last 5 or 10 years of 0% rates is not normal. That's not sustainable.
Such an interesting perspective because we're all, for those of us who are not used to seeing normal
You
interest
can say it
rates.
younger.
Yeah. For those of us that are a little younger, perhaps. I mean, I bought my first house. I'm gonna, I guess, show you how young or how old I am. My first house I bought, the interest rate was 6.5, 7%.
Yeah.
So that was my normal, right?
Right.
But when it all came down to, I mean, I had mortgages on properties that I owned that were 1% and 2%, believe it or not.
Yeah, well, I believe it.
So,
Yeah.
and you get back up to 5, 6, 7%, you're freaking out. But that's only because we were teased with 0% for, the better part of a decade,
Right.
right? Interesting.
So what that does for values is that those values have to adjust to be able to come to that realization.
Right.
If it's a 5% interest rate environment, then my cap rate's not going to be 5; it's going to be 6 or 6.5, something like that. But the problem is you got a whole lot of people who made the assumptions that cap rates were going to be 3.75 and 4,
Yeah.
and now they're not. There is going to be, I think, opportunities in terms of acquisitions of properties, particularly in the new construction by merchant builders, and in anybody who acquired a property like this in the late 20s, in 2021 to 2023.
So, what are your thoughts? I remember Ken was saying on one of his podcasts, he's talking about stay alive till 25.
Yeah, that's a fun saying.
Is,
Yeah.
is it 25 or is it 26 now? Have we kicked the can down the road? Are we starting to see a lot more of that pain? Or
Well, again, my experience is over this half a century is it takes no time to get into a mess, and it takes a pretty long time to get out.
that's a good way to put it.
So
It applies to all
they
things in
changed
life.
the tax act. They changed the tax laws in 1986, and in 45 days the market collapsed
Right.
for commercial real estate,
Right.
and it took 9 years for it to recover. So I think things take longer to happen than people like to think they're going to.
Yeah. So what is
So I'm a little skeptical about the stay alive to 25.
well, 50 years of experience will do that for you.
For our company, we have some challenges with our portfolio, but most of it is, our average interest rate in our portfolio is like 4.5%.
Right.
So, and we've done the vast majority of our portfolio is long-term finance. So, I feel like we're in a pretty strong position.
On one of the videos that Ken did a little while ago on YouTube, do you watch Ken's YouTube channel, by the
Sure,
way?
of course I do.
You see what's going
I'm
on.
required. He sends me a quiz
Yeah, he sends
every
you-
Monday afternoon.
So I saw in a video a little while ago, Ken was talking about his plan, or I guess your plan, to acquire about $1 billion in real estate in the next little bit. I guess the question is the plan mostly development driven, acquisition driven? Like what does that look like potentially?
Oh, we can't build $1 billion in a decent period of time. I mean, but today $1 billion is 12 properties.
Yeah, when you put it into that.
And when we, 12, 14, 15 properties. So that is, and we've done that kind of volume in the past. So
Yeah.
if we see the opportunity, then by all means, we're ready to go get it.
Yeah. And when you guys look at expanding your client list, I mean, I know you guys currently hold is about 10,000 doors in the portfolio, about 2 billion in assets. And when you look to expand to bring on potentially another billion in assets, like how does the company evolve on the capital stack, on the team side? Like maybe paint a picture there for us a little bit.
We have a strong infrastructure that is able to absorb that level of acquisitions. Having said that, that means we have to find the right people to fill the slots that are going to come that will be necessary to be able to sustain that kind of growth. But as to we have the space and we have the processes, we have the
systems, the integrations, all that stuff. Yeah.
And we have the senior management that's capable of it. Just the challenge is going to be finding the product. We have a discipline about this. So when we have an investment committee meeting, which we do every Tuesday, our acquisition teams presents a opportunity. And, the first thing we ask is, well, what's the story here? And is it a story that we can sell to our investors? For instance, we had one this last week where it's an opportunity to acquire a building that's been owned by the same guy for 35 years. And the building's in Phoenix and he lives in Florida and he hadn't been there in 20. So, but he also believes in spending money on the property. So it's very well maintained, but they're not taking advantage of maximizing income. So there's management play there. And so as opposed, and maybe it's a renovation play, or maybe it's, like I said, a development issue. Or the story is X developer needs to get rid of it because his loan's coming due.
Yeah.
So, and then you start looking at the fundamentals like we've talked about. Like, does it work? Is it the right place? Is it the right product in the right place? Is it manageable?
Yeah. What's really interesting to somebody who's kind of observed this for, call it, 2 decades now and watching you guys grow is that all those little things that eventually a mature company incorporates, whether it's, knowing what carpets go, tiles, the relationships, the monitoring of employees, the email policies, the SOPs, the disaster recovery plan, if something happens, all these different little, there's thousands of these little things that weave together and create the organization after, call it 20 plus years. And what's interesting is once you're running at 2 billion, there's really nothing stopping you from being 3 billion or 4 billion.
No.
And expanding and growing, because all that risk has already been worked through over 24 years of deliberation. Let's call it that.
The challenge for us is going to be, if it is increasing our investor base. We have a 4,000 investor base. We have investors that have been with us since I started my company
Is that right?
37
Wow.
years ago. And so, how do we get to the next level for that? And that's, to me, the exciting part and the intriguing part about where we go from here.
I'm also very excited about that part.
Well, I know you are.
Just so you know, because I look at the business and I think to myself, like, obviously the story is fantastic, the development, the history of it, but also the stability and just the rationale, the rational way you guys have built the business and avoided the quick hits and the temptation. And, because in the last couple of years, you guys could have bought a whole bunch of stuff, I'm sure.
Oh, yeah.
But there were many times, Ken was telling me how many times you guys actually had to, let's call it, articulate to your investors why you weren't buying certain things when everybody else was buying everything.
Right.
And today you guys are the smartest guys in the room because of that. And you don't have a bunch of black eyes on your portfolio, because there's a lot of people, you and I both know them in the space, that they're currently, maybe they're a billion in assets, but let's see.
Are they paying you?
Are they paying? Are they paying you? Or are they paying anyone? Right. So
we've just been really blessed with having such a great group constituency of investors and employees and lenders. And I think there, certainly there's a challenge about, how you keep your identity and culture and move to that level of growth. My wife and I talk about it all the time because we both believe that our, MC is a special place. And that's how we will succeed, is by keeping our identity intact.
Yeah. MC companies to me is literally the epitome of, the saying, when you take care of things, they last. And when I look at you guys, look at your organization, look at the story, look at the culture of the team, even the little details, like the hedges are trimmed properly, the pool's clean, like it's all these little things. It's not one big flashy flash in the pan, one thing, but it's a ton of these little things that collectively really kind of just encapsulate the vision and the mission. And anyways, I appreciate the opportunity to be here today and interview you. And I'm looking forward to seeing you guys. I'm really looking forward to seeing you guys do that 3 billion, 4 billion plus. So thank you, sir.
Thank you, Marcin.